All right, good morning, everyone. It's Matt Donahue, Jason Dufault, and Kenneth Hamilton with Mission Financial Planners. This is part two of three of our spring tax planning webinar series we're doing. Next week, we're going to focus on the BBB because that is the current tax law. That is what everybody's going to be functioning under for the next 3 to 5 to 7 years. What we're going to focus on today, though, is the Secure Act 2.0, which passed a few years ago. And the reason we're focusing on the Secure Act is because a lot of you are at that point in your life where you're starting to wonder about taxation and retirement and how do the rules potentially change. So the Secure Act 2.0 was the single biggest change in tax law when it comes to retirement, probably in the last 40 years. And I don't think that's an exaggeration. If you think back 40, 50 years ago, things like 401ks and so on were just being created by Congress. Well, it took a long time, but it's 40 years later. And then Congress took a look at Secure Act, the first version, then 2.0. And what it did was it acknowledged some of the realities of people aging in the 2000s versus how they might have aged back in the 20th century. So, which is funny for a guy born in 73 saying back in the 20th century. But we're going to go through some of the highlights with you. We'll elaborate on a couple key points. We're going to keep this, and I'm going to ask anybody who's on to hold us honest on this. We're going to keep this to 30 to 40 minutes. We could easily go for 3 or 4 hours. We don't want to wear you out. If there is something you have a lot of questions about or you really want to drill in on, go ahead, throw it in the chat. Go ahead, reach out to me, Ken, or Jason personally, right? We're happy to have a conversation and see if we can help provide additional clarity for you. So let's go ahead, jump in. Oh, I almost forgot from a housekeeping item. Feel free, throw questions in the chat, throw questions in the Q&A. There's 3 of us on today. We won't all talk at the same time, I promise. And we'll be monitoring the chat Q&A as we go. Okay, we're going to throw this in the chat as well. Some of the highlights on the Secure Act 2.0, so you've got a bit of a handout to go with it. But essentially, what the Secure Act did was it introduced about 100 new retirement rules, which there will be a quiz later. I'm just kidding. There will not be a quiz. But it did. It introduced about 100 new rules. And what ultimately happened was it didn't just affect individuals, it also affected businesses and business owners. And so what the intent of the both versions of the act was to help people be better savers and also urging businesses to make it a little bit easier to do so. And Jason and I were having a conversation this morning about if you put in a 401k for your employees as a business owner, when you're doing it, a lot of times what will happen is the rep from the 401k provider will come out and they'll say, here you go, here's your plan. Great, thank you. And you'll see them next year when it's time to enroll some new people or just do an annual update. Very, very seldomly does that person have a conversation with you as the business owner to say, look, here's the potential impact for you as the business owner by installing this 401k. And usually the impact's pretty positive, right? But you need to make sure you understand what that is so that you're doing the right thing, not just for you, but also for your employees at the same time. And of course, planning is key. You can see it. Ooh, look at that. I almost did it perfectly right there. There is our 5 pillars of financial freedom. One of the pillars, of course, is tax planning. And our goal is always to make sure that you're making informed decisions so that you can get the best possible outcome with the rules we have to operate under today. Will those rules change? I can almost promise you they will change. Just don't know when. And as we go, we will make updates and we will adjust the plan as needed. We are certified financial planners. We are not enrolled agents. We are not CPAs. We can help you with tax planning. We can explain how a bunch of stuff works. But if you are looking for official tax advice, you do need to consult with a CPA or an enrolled agent. They are the only people other than tax attorneys who can actually represent you in front of tax court. So enrolled agent, CPA, tax attorney, they're all great resources for you. If you are looking for actual tax advice, let us know. We have a lot of great partners who can help you with that. Okay, big question. And what parts of the Secure Act are going to impact me and my plans for retirement? So Ken and Jason, who wants to elaborate on the first key of the Secure Act 2.0?
I can do that, Matt. So
Okay.
uh, it's about more time you have to save for retirement. So there was a couple of key things they did with retirement, knowing that um, a broad base of the population is not prepared for retirement, and changing some of the important dates when they put the 2.0 together to allow people more time to get ready for retirement and for late bloomers. So one example, as Matt shown here, is RMDs. Used to be before the Secure Act got launched in 2019, or when it launched in 2022, 2020, in 2019, RMD started at 70 and a half. So as soon as you were 7.5, ready or not, here they come. You're taking required minimum distributions out of your 401ks, IRAs, 403Bs, and 457 plans. And if you need the money or not because you're still working, it doesn't matter.
So when we're putting it all together, right, if you're thinking about retirement, your probably three of your crucial dates you want to make sure you understand, or birthdays, I should say, are probably 65, 67, and 75 if you're born after 1960. And the reason I focus on that is 65, of course, is when you're first eligible for Medicare. 67 is when you hit full retirement age for Social Security benefits. And of course, 75 is when you have to start taking those distributions. Now, Jason, it used to be really punitive if you missed a distribution. It still is, but not anywhere near as bad as it used to be. Do you want to elaborate on that a little bit?
Oh yeah, much less so. I mean, before they were pretty aggressive about missing a distribution. They'd hit you with a 50% penalty. So if I would had a $10,000 distribution I was supposed to take and I didn't, well, you're going to send five of that to the IRS and take your five and still pay tax, right, on the whole thing. So it was extremely punitive from that end, for that part. They finally, realized that sometimes people miss these things and took it down a notch to 25%. But most of the time, if you got a good tax preparer, you can get it down to 10% because they know that people make mistakes as long as it's not habitual.
Yeah. Yeah, that's a key in the tax code is the occasional mistake, believe it or not, does not get punished anywhere near as hard as continual mistakes. So, um, okay, so you're in retirement and your spouse dies. Ken, how did the Secure Act change rules for that surviving spouse?
So they can now adopt their deceased younger spouse's R&D schedule. And so what that means is you have the ability to stretch out the required distributions over that lifetime. And so it's less dollars up front, or you have the ability to take less dollars up front, which could cause this tax impact of you needing more and more dollars to pay more and more taxes. So if the surviving spouse dies before RMDs are initiated, their beneficiaries would be allowed to stretch the distributions over their lifetime, avoiding the new 10-year rule for distributions.
Fantastic. So, if you have a younger spouse and your younger spouse happens to pass away before you can access their RMDs or their retirement accounts, but you can do it over the course of your lifetime. You're not forced to take it out at a faster pace than what you might have been otherwise. I'll touch on this one real quick because Ken and Jason, you've heard me talk about this over the years in our Social Security workshops. My dad is a perfect example of someone like this. He worked till he was 78. I always used to joke that the reason he worked so long is he was kind of afraid of my mom. But the reality is he really liked what he did for a living and was able to do it well into his 70s. Well, 78 for him was almost 10 years ago. And so at that time, if when he kept working, he couldn't contribute to an IRA after age 70 and a half. He couldn't. That was the cutoff. Today, if you're one of those people who really likes what you do and you're going to keep working, or you took that retirement passion job and you're making some money for that, and you're not exactly sure what to do with the money, you can still do contributions to IRAs after 70 and a half. You just have to have earned income. So it does provide a bit of an opportunity for you. Jason, for next couple slides, I'm going to defer to you on these. So when people they're getting ready to retire, every now and then they feel like, oh my gosh, I am behind the eight ball. I just got done paying for college. Maybe I helped pay for a couple weddings. My retirement accounts are not where I really wanted them to be at this point in my life. What are some of the options I have?
Yeah, this is huge. This was a huge thing they added to the Secure Act 2.0. Because basically what they did is they took those catch-up contributions and expanded them a little. Like one of the ones that most people know about is the 60 to 63, where they took it to the greater of the $10,000 of additional catch-up or 150% of the regular catch-up contribution for. So 2026, that's going to be $11,250 of additional money that they can put in their 401ks or 403bs, right? So when you're feeling behind the eight ball, that's a significant amount. To put that in comparison, the normal catch-up a couple of years ago was only $7,000, right? So they're giving you even more money to put in there from that end. What was super interesting about what they changed in here, too, was how they allow you to allocate the catch-ups. Meaning, if you're considered a high income earner, making over $145,000 as a single, or I think it's 236,000 as a couple, then you have to put the catch-up in the Roth component of the bucket. Because part of the change in the act was also to make employers provide a Roth component in their 401k or 403b. It's not an option anymore if the employer wants to do it, it's you have to do it. So those were pretty interesting. There are some smaller plans for small business owners with simples that allow for higher deductibility and catch-ups too, like the 5,000 or it's 5,250 this year. We don't see a lot of those just because they've done a lot in the 401k space to make it more appetizing for small businesses.
So like we talked about with key dates as you're getting into your 60s, there's some key dates as you're in your 50s and 60s as well, right?
Absolutely. There's very, very much key dates in there. I mean, at 50, obviously, we know that's the catch up when people can start putting what's 8,000 today, which was 7,000 two years ago from that end. And then obviously the 60, 63 I just talked about. And then once you get past that little window, then you're back to the normal catch up for that part. But it's significant.
Right. Okay. So I might be thinking about all these rules and thinking, hey, I should put some more money away. Well, it does give you more ways to save, or it did give you more ways to save. So Roth changes at work. Jason kind of touched on this a little bit, but employers can make matching after-tax contributions now into Roth accounts. The key word there, folks, is can. They don't have to. Okay, so if you have a Roth 401k and your employer is doing a match and they're putting it into the traditional 401k, if that's the way the plan is built, that's the way it's going to work. If they did set it up or they did revise the plan so they can then make the Roth contribution, then they can make the Roth contribution. But the key word there is can. There's no more RMDs. So if you have a Roth 401k and you're happy with the 401k, leave it in the 401k. You don't have to start taking money out like you used to. And then Jason mentioned the catch-ups as well, those high income earners. That's something that can go into Roths as well. So auto enrollment. So companies are required to auto enroll. Year one, it's maybe 3%. Year two and beyond, it can go to 10 to 15%. An example of a company that used to do this, and I'm sure, well, of course they still do because it's now part of the law, was UPS. UPS had a great system where, if you started there just loading trucks in college, like a lot of people do at UPS, or loading trucks, that's your first job at UPS. They had an auto enrollment feature where you had to opt out of it if you didn't want to put any money away. And then they would gradually ramp you up over time. I'm not saying every plan out there works like that, but that's an example of a plan that does this and does it really, really well. So if you're not sure if your plan do this, check with your HR team. And if you're the decision maker and you're like, hey, I'm not sure if our plan does this, give me a call, or give us a call, I should say. Ken, do you want to talk about annuities in 401ks? And if you could mention the hype around it, and then maybe a little bit about the reality of what you've seen with the annuities in the 401ks.
So it's one of those many things that, while it's possible, there hasn't been a lot of case studies of real implementation of it. The opportunity comes in is being able to, as you can see, create lifetime income from within your 401k plan. But again, all this would have to be approved and provided by your employer. So where this actually happens is when you are a small business owner, you control your 401k, and that's really where you're going to see it. So there has been news about it, but the application has been limited thus far. And even then, it's been to the companies with less than 5, maybe even 10 employees where we've seen it actually take shape.
Right. And then I don't know, Jason or Ken, if you want, which one of you wants to talk about 401ks for the next couple slides?
Yeah, I can do that.
Mhm.
This is what I was talking about before, where you don't see a lot of simples anymore, is because they've enhanced the starter 401k plans. They made it easier. The 401ks had a lot of heavy administration around them, and now they've created a simpler process, really, which is what a simple was designed to be, which is now probably going to get replaced by this starter 401k from that end to make it just solely linked to, current IRA limits, and it's a very easy process for an employer to put in.
Yeah, and I mentioned earlier, if I'm doing that passion-driven job and making some money. Hey, if you're working at least 500 hours a week, you're going to be able to contribute to a 401k potentially. So, part-time workers, it made it a little easier for them as well.
The only thing they did with that, Matt, to make it simpler for the employers too, was for a 3-year time frame. So if you've
Thank
been
you.
working as a part-time guy for 3 years, 500 hours, then yep, they got to let you in a 401k.
Yeah, thank you. All right. SEP and simple plans now have Roth options as well. So the key with that, just remember, anytime you do a Roth contribution as an employee, it still counts as income to you. So you paid the taxes on it, it goes in, gross tax deferred comes out tax-free as well. But from a SEP and simple standpoint, again, for small business owners, you have some flexibility now that you didn't have in years previous.
Yeah, we see that a lot with solo, the solo entrepreneurs, the sole
mhm,
proprietors. They do a lot of SEPs. We've seen
mhm.
it a ton.
Emergency savings. This is something as well that again, it might not sound like much, but emergency savings, if you look at one of the number one things people are concerned about with financial stress is what if I have an emergency? Okay, this could help, right? And a lot of people have asked us about emergency funds over the course of the year or over years. And typical rule of thumb is 3 to 6 months of expenses should be in emergency funds. Typical rule of thumb. So, from a planning standpoint, while this can help, this probably won't be your primary mechanism for that emergency fund. And then there are some qualified student loan payments as well. I haven't seen a ton on this in my personal practice. Jason and Ken, I don't know that you guys probably have either. Um, but from a planning standpoint, an employer, could make a matching contribution, and then you could use that for some qualified student loan payments. And that would include graduate and postdoctoral work as well. So, but I haven't seen that a lot. I haven't seen a lot of people take advantage of that.
Now, I've probably only seen it one time, and it was a bigger outfit, a bigger hospital that was doing it from that end, and they would say, okay, obviously doctors tend to have a lot of student loans
Right.
from that end, just because the
Right.
cost of getting through the program, right? And that part. And what they ended up doing was they're saying, okay, hey, your doctor, we know you're paying your student loans off because you have to, right? Let's still put a match in for you, even though you can't afford to put into the program today
Yeah.
from that end. And it seemed to be received very well by them.
Lifetime income estimates in your 401k. I'll touch on this real quick. A huge note of caution with this kind of thing, right? You log into your 401k and it's like, oh, it's going to pay me so much money a month, when I retire at a certain date. Well, it's assuming a certain interest rate, it's assuming a certain number of years, it's assuming that continual funding happens, right? There's a lot of assumptions that go into it. Don't just look at that number and go, oh, hey, I'm great. Look at that number and look at what the assumptions are. What's the rate of return they're assuming? What is the payout rate they're assuming in terms of how much money are you going to take out every month? Because one of the things we run into quite often with people is during periods of market volatility, like now, some people wish they had more what I would call reliable income streams, bigger Social Security, bigger pension, maybe some annuity income, maybe some real estate income, right? Stuff that they know is going to come in every month, regardless of what the S&P is doing or what their portfolio might be doing. So it's just a note of caution with this stuff. Make sure you understand what the underlying assumptions are when you look at these income estimates on your 401k. All right, Ken, key number three. Okay. We've seen a lot on savings, but this really gets into, okay, how do I access my funds in retirement? So take us through
Yeah, so
QCDs.
we've done a fair amount for this with our households is doing qualified charitable distributions. RMDs, as we mentioned, start at 73 and 75. It used to be 70 and a half, and that's when QCDs can start. They have not adjusted the age, so we can still do this in advance of that time point. It used to be $100,000, but now it's going to be indexed for inflation. And Jason, correct me if I'm wrong, it's 111,000 this year.
That's exactly what it
Yep.
is.
So a lot of you are already charitably inclined, regularly giving to your church or charities on a regular basis. For a QCD, is if you were going to give $5,000 from your checking account, well, you've paid 5,000, you've paid taxes on that 5 grand. So it really cost you, call it $7,500 to get that 5 grand. Well, now you can give that $5,000 directly from your IRA. You don't pay taxes on it, and the charity or church gets the full $5,000. And so you just increased your the magnitude of your dollars by 22 to 25%. Um, some of our households are saying, hey, well, I was going to be paying that money in taxes anyway. Why don't I just give that $7,200 or whatever that number ultimately is? But again, that dollar amount is going to be increasing with inflation over the coming years. And again, between 70 and a half and RMD age of 75, it's an opportunity to maybe reduce some of those RMDs that we're expecting.
And then Jason, can you touch on the split interest entity and how, the one-time rule with QCDs allows you to fund that charitable trust,
Yeah, I think it was done in good faith, but what the split interest is normally can't give a QCD, but to a nonprofit charity, a 501(c)(3) registered with the IRS. What they did is they said, hey, when you have something like a charitable trust, right, a charitable remainder trust, charitable lead trust, you can gift 50,000 into a charitable remainder or charitable lead trust. It's called a split interest gift because part of the interest comes back to you and part of the interest goes to the charity, depending on which side of the lead or remainder you're on from that end. And like I said, good spirited. It's just very hard for those type of instruments to work without, something north of 300,000 of funding and actually have a meaningful impact.
thank you. And then they also added some flexibility around 529s. One of the questions we have from people when they're trying to help a child or grandchild go through college is, well, what happens if they don't use all the money? Or what if that kid gets a big scholarship and doesn't need it, for whatever reason? What can I do with those extra funds? Well, one thing you can do is if you did happen to take out some student loans along the way, but maybe still had some money left over, you can use the 529 to pay back a certain amount of that. They can also be used to help fund other things that they weren't allowed to do in the past, which are things, and you can see some of them here: apprenticeship programs, private K through 12 education, things like that. So 529s have a lot more flexibility than they used to have, including the ability to be transferred into a Roth account. So as a parent, you could maybe supercharge a Roth IRA for someone. Let's say you do have that kid who's getting the scholarships, and I'd have to check to see if this number's tied to inflate or adjust for inflation, but you could do at least 35,000 as a Roth conversion for someone or into a Roth account for someone. So there is a couple tricks though, right? One is 15-year. 529 has to be at least 15 years old. And two is the 35,000 is a lifetime cap, which means you could do 7,000 a year for up to 5 years. Okay. So there are some rules around that. Just make sure you understand the rules. We don't want anyone to get disappointed. But if you've got a 22-year-old who's graduating from college and you got a bunch of 529 money, what a great way to help them get started with retirement savings.
Yeah, you should definitely contact us on those rules because there's a couple of eligibility things in IRS and a couple of things with the 529 that you need to know.
Yeah. I can touch on the long-term care insurance. So an employee can pay up to $2,500 for their or from their retirement plan to fund long-term care insurance. You'll see it says LTCI. Okay, what that means is you're talking about a traditional long-term care policy. It means it does not build up any kind of cash value. So it's not a hybrid life insurance or annuity-based long-term care. It's traditional long-term care only. There are some limits on how much you can take out to do it. But that traditional long-term care policy, what I would suggest is if you're in your 40s, you absolutely need to start shopping for long-term care insurance. The pricing is phenomenal for you at that age. Your health is most likely the best it's going to be. Those of us, I know we have a lot of people over 50 and 60 on today's call. Me at 52, I was just whining to Jason about, sciatica and how I have to do a bunch of stretching and stuff like that every day for my sciatica, right? Matt 15 years ago wasn't even thinking about that stuff. So, we all get older, right? But the key is if you're in your 40s, and I know there's a lot going on in your 40s between kids and work and everything else, that's the time to start getting this stuff in place. So take advantage of it, take advantage of your health and the cost structures that are there as well. We're going to touch on this a little bit more next week because there's also the new Trump accounts that have come along. So we'll dig in on some more child related stuff next week. But penalty-free IRA withdrawals. Hey, those of us who have kids, we all know. Those of us who are aunt and uncles and grandparents and everything, we all know those lovely little kids are expensive. So maybe you're a really aggressive saver for retirement, and you always have been. And maybe you do need to get your hands on some extra money for something when that child's born. Go ahead. You can pull 5,000 without the 10% early withdrawal penalty. The key is you got to do it within a year of that child being born or adopted. Okay. So if you go beyond that first year, you lose the window to do it. Some other things: terminal illness, domestic abuse, public safety workers. Public safety workers, I don't know how this wasn't included in the original definition under the original Secure Act, but firefighters are covered by the Secure Act 2.0. So the rule is basically retroactive to disasters that occur 21 and later, and it allows for a maximum distribution of $22,000. You can take it, but you also have to repay it. Okay. There are retirement plan loans for people who live in a disaster area, and those are up to $100,000 now. So you've got some flexibility there to get through a short-term crisis. Like I said, maybe you were aggressively saving for retirement. Your emergency funds were a little low. You just bought new air conditioning or something, right? You wrote a check for it, or you just bought a new car and you're like, yeah, I'm going to build up my emergency fund again. And then the hurricane hits, right? Take advantage of these rules. Take advantage of these rules. In many cases, this is going to be way better than trying to get a note from a bank. It's just all the way around. So make sure you take advantage of that if you need to.
Yeah, and I can tell you where we saw a lot of this, Matt, was doing exactly what you said, the hurricanes, because a lot of times folks don't have flood insurance because they thought they were in an area that never flooded before. And guess what happened this hurricane? It flooded. So the 100,000 is huge to help those people kind of get back on their feet.
And I know we know a ton of people in California who were hit with the wildfires last year. I can promise you there are some people there who still don't know that this was available to them. So
absolutely.
You got to make sure, and folks, this is one of the reasons you work with a financial planner, because when we're calling to say, hey, are you okay? And you say yes, first of all, we breathe a sigh of relief. But if you say no, that's where this is one of the examples where we can spring into action and actually help you at that point. Because let's face it, if your house just got flooded or burned down, the last thing you're thinking is there a loan available in my IRA?
Yeah.
It's not, wouldn't be going through my mind. So, all right. Big IRAs. We have retired successfully. We were long-standing clients of Mission Financial Planners. We did everything they told us to do, and retirement has gone off without a hitch. And now we're just seeing our wealth grow in retirement. We want to leave it to the kids. What can we do? So guys, who wants to jump in on key number 4 here?
I'll take it. Is your kids can get the dollars, of course. Yesterday, they were able to stretch it out over the rest of their life. And that was called the stretch IRA. But now it has to be done within 10 years. So just imagine if you left $1 million to in an IRA to one of your kids and you just stretched it out over 10 years and there was no growth, which there would be, that's $100,000 a year of extra income. What bracket is that going to put them in? What happens if they only took the minimal amount and now they're taking $1 million plus at year 10? What is that going to look like? So being the burden of planning for this uh, is, I think, falls a little bit on the parents, and just doing a little bit of work today can help mitigate some unnecessary taxes that might befall on your kiddos or those that you care about leaving your dollars to.
And Ken, if
Matt?
I could just add one comment to that, the
Mhm.
question you want to ask yourself is, you paid taxes on money. Do you want your kids to pay taxes on the money too? That's the question you should be asking yourself, because can we minimize the tax, or can we create something similar that is going to leave all that money income tax free to them without all these rules in terms of how you can do it? There are ways to do it. If you're interested, you want to learn more about that, let us know. Ken, I did not mean to steal your thunder there.
Oh, no, please.
All right. So, Ken, going along with that, what about inherited accounts now? So, you talked a little bit about the 10-year. Does that apply to Roths as well?
As well, also
Okay.
need to be liquidated within 10 years. But again, comes that opportunity of one, they can liquidate it all year one and there's no taxes. Maybe they now plan on liquidating all in year 10 and fully growing it. But there's a major risk when it comes to inherited, both traditional and Roth accounts, is that they do not have the same legal protections as an IRA or 401k. So again, this isn't talked about in the Secure Act specifically, but if your kiddos were to be sued for any particular reason, homestead, a vehicle, and retirement accounts are protected, at least here in the state of Texas and uh, mostly in California. There's an asterisk there for our California clients, but inherited IRAs, both traditional and Roth, are fully exposed. So again, leaving it in those accounts for the full 10-year period actually might have an increased level of exposure that maybe you were unaware about. Jason, I feel like you have a nugget on this you'd want to talk about as well.
No, I mean that kind of covers it, man. I don't know a state that I've looked at that. I mean, what are we working now? 36 states, and every state
Mhm.
we've worked in, and we looked at this for clients, inherited is always exposed to liability, and it's counterintuitive to what people think.
So if you are a surviving spouse, you can take the IRA, traditional or Roth, put it fully into your name. And then again, it would follow your rules, the RMDs, all that. But if the beneficiary is also within 10 years of the original owner, so maybe it's a sibling of yours, you can absorb it into your own account. That's a new one, huh? I actually don't recall hearing that one before, but is that right?
Yeah, that is correct. That is
There
correct.
you go.
See,
Uh,
these webinars are good for us too, you know. So,
but disabled or chronically ill beneficiaries, granted that there's a process and forms and things like that, but that there are ways to extend it beyond the 10-year rule.
yeah,
Um,
so oh sorry, go ahead, Ken.
no, please.
Yeah, so some of the lessons that you want to take away from this, and we're kind of in the home stretch here. Um, the tax planning is more important than ever. There are loads of, as you can see, considerations when you're thinking about what's the best way to manage an RMD, just as an example. Or we put a ton of money into 529s, the kids didn't use them. What should we do with them? Just as an example. Okay. If you're focused on the stretch IRA going away, okay, or you're worried about, oh my gosh, my kids are going to get hammered with taxes if they have to take this money out over a 10-year period of time. I'm not even going to touch on these 5 bullet points on the screen. because every one of you is different in terms of how you might go about wanting to manage that. It might be a Roth conversion. It might be you're sending them money, right? But regardless, you've got to manage your tax. And when we say tax, I think everybody who knows us know that we talk about three things with tax. It's the federal, and for our clients that live in states with an income tax, it's the state income tax. It's also Medicare IRMA surcharges. We look at all three of those. Are your beneficiaries current? We had a client pass away recently who didn't update beneficiaries on life insurance policies. Guess where the money's going? To the beneficiary. That's on the form. That's where the money's going. And then, does your estate plan make sense? What I'll stress with this is equitable is not equal. Okay? You want to be fair. Everybody wants to be fair, right? But that doesn't mean everybody has to get the exact same thing. What is equitable versus what is equal? Equal may be important to you, and if it is, that's okay. But at least think about what's fair to everybody else.
Yeah, we actually have a good story on that, Matt, if we have time for it.
Yeah, go ahead.
One of the clients that we work with has two sons, and one of the sons is doing really well, and one of the sons has very poor health and is on aid from the state. Well, it goes back to this equitable and equal you're talking about. He won't be off that aid from the state till he's 65 years old. Well, he's only 58 now. So if that client were to die and give him that money, where do you think that money's going to end up?
Yeah.
The state's going to eat it
Yeah.
because they're going to be like, hey, you have resources, you can do it now, right? So would it be equitable to give him a 50%? Of course it would. Would it be fair? Probably not.
Exactly. But the key is have a conversation, right? Where families get sideways on that is nobody knows the plan until mom and dad are both gone.
Yeah.
And all of a sudden, that's when the knives come out. So just make sure you have those conversations. Okay, we went through 4 big keys with the Secure Act. Okay, more time for retirement, more ways to save, more ways to use your money, and then also ways to pass on your money. We can help you if you want to do a review. There's been a lot going on in the world so far this year. We have a lot of people on today's call. We have some people who are clients, some people who aren't clients. At a minimum, what I would recommend is we do a retirement plan review. If you're already retired, is it where you want it to be? What changes need to be made? What's changed in your life since the last time it was reviewed? If you're still working and getting ready to retire, I will say this, it is never too early to start the conversation about how do I make sure I have a good plan for retirement? It is never too early to start that conversation. And I'll just stress, you've heard us say this over and over. We do not force you into a plan. We want to find out what's important to you and what plans make sense for you so that you're making those informed financial decisions that I talked about at the beginning. So thank you for your time. We had a lot of people on today's call. Ken, I know you dropped our calendar links in the chat. If you could, I'm going to drop the handouts in the chat from today. But while I'm doing that, Ken, would you be willing to take Jason through just what were the top 2 or 3 questions you saw in the chat today, so everybody can hear it?
Sure. So, Jason, as somebody who's developed substantial IRA assets, what really is the top 2 to 3 steps they should be thinking about?
One is, for a lot of the clients for several of the clients we meet, they have potential IRA assets that they can't spend over their lifetime, right? And the challenge is those IRAs compound with no tax. And what happens is you create an enormous tax burden to those kids or kid if you only have one, right? Or whoever those heirs are, unless it's a charity. So what they need to be thinking about is, hey, not just the tax in my lifetime, but the tax over my kid's lifetime, right? I've worked hard for this money. How do I make it last longer from that end? So essentially tax planning around the kid's lifetime too, because of your hard work for that part. B is understanding the asset protection that you have or don't have with the way your retirement accounts are set up today. Each state dictates asset protection and what they will allow and what they will not allow from that end. Like you said earlier, right? Homestead is pretty common around most states. Other than that, there's not a lot of commonality in this. So 401ks and homesteads are pretty much your staples. Once you get past that, every state's different. What they allow, how much, when, how long, all of that stuff. Know how your assets are protected because the next biggest viable candidate to take your money besides taxes is a liability, right? A lawsuit.
Now, this is coming from some of the cases we're working on now. We found a lot of opportunity working with business owners. Do you know, I know there was a couple slides on it, but can you give like some rough numbers or outline of the opportunities for some of the business owners that we might have in our life that they might not be aware of?
Oh man, that is a booklet of stuff. So
Whole workshop? Okay.
yeah, it's its own separate workshop that Matt could put together
Jason, give
for.
us one and then we're going to wrap up. Give us one.
Okay, so one example is a lot of business owners have a negative cost perception of a retirement plan, right? Hey, I'm going to put a retirement plan in. I'm going to give 90% of the money to my employees and I only get 10, right? And a lot of that has to do with the way they're reading the laws and the professionals they're talking to. There's actually component pieces to a retirement plan that you can strap on to a 401k that allows the business owners to substantially benefit themselves and do that. So, for example, we have an insurance business owner that we've worked with for 10 years now, I think. If it's not 10, it's approaching 10. And what she was able to do was still compensate her staff with a 401k and profit sharing, but also allow herself to save over that probably 7 years the plan's been in place, about $700,000 over the course of that time, which weighted the plan heavily towards her to catch up. We talked about catch ups earlier, which was a massive way for her to catch up from being behind the eight ball of running a business and not doing the retirement planning for 35 years from that end. So there are parts of the code that allow you to do that and follow all the rules and compliances that exist. You just got to know them.
All right. So just got to know them. That's what you use us for. So again, if you're at all concerned about any of this, please reach out. We are happy to have a conversation. Don't forget, follow us on our YouTube channel. Make sure you like some of our comment or content out there. And then thank you for making time to join us today, everyone. Have a great rest of your week, and we will see you all soon. Thank you.